Filippos Falieros. I'm an advisory leader for Aurora Energy Research, covering the markets of Southeastern Europe. And I'm delighted to guide this panel of conversation with truly diverse experts from financial institutions, legal advisors, but also project developers. I would like to ask you to introduce yourselves briefly. So, Manuela.
Hello, I'm Manuela Naessl. I'm the head of the EBRD, the European Bank for Reconstruction and Development in Bulgaria. And we are, of course, very much engaged in the energy sector. Hence, I'm representing the EBRD here today.
Hello, Alexander Zahariev, head of M&A and Structured Finance in SUNOTEC.
Hello, Nikola Mihajlovic. I work in International Finance Corporation, part of the Bulbank group, and I'm in charge for Bulgarian market for the team that does investments in the energy and infrastructure sector. Thank you.
Hi, my name is Dimitar. Shalamanov. I'm heading the project and structured finance team of UniCredit Bulbank. Really pleased to be here, and thanks for the invitation.
Hello, good afternoon. My name is Nikolay Petrov. Today I represent the European Investment Bank. We heard mentioning EIB a few times in the previous panels, so today I'll try to discuss and talk about the new initiatives of the bank.
Hi everyone, I'm Dimitar Zwiatkow from CMS Sofia law firm. We're advising clients from different sectors and covering all kinds of energy topics. Nice to be here.
Great. So let's begin by setting the floor and discuss how Southeastern Europe region is maturing on a financing standpoint and what trends are shaping and how risk is perceived and priced. Manuela, perhaps you can begin by kicking us off.
Thank you. Yes, absolutely. I think we were trying to look here at the trends that we have seen in the renewable energy space. And I think one thing that particularly we as a bank have seen is that whilst previously, in other markets we had seen a lot of financing with power purchase agreements or based on CFDs, we really have seen recently more fully merchant projects coming to market, that do not benefit from a PPA or do not envisage to have PPAs in place, at least at the time when they're financing. And that's really a change that we have been seeing that, of course, has also risk implications, but it's something that I think as a bank we have been getting comfortable with, and we are also working here with the local commercial banks on these projects. For example, UniCredit, of course, was one of our partners in this. Another trend we have definitely been seeing is that a lot of developers, and this is probably the larger developers, are trying to finance portfolios of projects. So rather than having single PV projects, single wind projects, they are looking at portfolios of projects. Sometimes this could be PV with battery storage systems, but it could be also very much larger projects where it's like 4 or 5 projects that are coupled together. And often these developers then look either for equity type financing to develop projects further down the line, or for sort of a debt package for several of those projects. And of course for us that is a very difficult sometimes to assess these projects because they're larger, but it allows, I would say, some efficiency. It allows a larger package with several banks to be put together. And of course it has a certain sort of reduction of the risk if you can look at sort of more packaged deals together. Coming back to, I would say, the merchant plants, I think this is something that I also assume we will see more and more in the local market, and that it's something that I think we all have to get to grips with and to work on, because given that what we heard on the earlier panels as well of the difficulty around PPAs and achieving long-term PPAs, assuming fully merchant risk in the financial sector is I think very important. And I'll leave it there for the moment.
Thanks, Manuela. And building on that, maybe Nikola, Manuela just mentioned how investment portfolios help de-risk, but what about physical connected investments like co-located projects? How do you assess those in IFC?
So I understand this question that you're asking me, what is the difference if you have a co-located, let's say, solar PV and battery projects versus having two different projects at different locations and building a virtual portfolio. I think that in the context of very liquid and well-functioning unified wholesale market, the differences are actually not that big, because whether you are using your battery to charge your solar PV plant to charge your co-located battery, or you are selling from the solar PV in the grid, but then drawing from the grid to charge your battery, at the end of the day, from the cash flows perspective, you are likely to achieve a very similar outcome. Obviously, where it does help to have a co-located project is when it comes to grid resilience and being able to better manage some grid-related events, such as curtailments, for example, where with a co-located facility, you have some flexibility to at times of grid lack of availability to channel your generation from the solar PV plant into the battery rather than being curtailed. And I guess to some extent also, if you have a co-located project, you benefit a little bit from the economies of scale when it comes to some of the operational expenses, but I think that's probably on the lower side of the efficiencies that you can achieve.
Thank you very much. And yeah, allow me to add from a market perspective here, the curtailment risk mitigation in a co-located project, and that risk discussion can move us to Nikolay, Petrov. And how do you assess credit risk of different groups of off-takers, either industrial or corporate, as already discussed in previous panels?
Thank you. Yes, I will come to that, but just if I made a couple of words just to present the EIB and our activities in the energy sector, because I think we are quite important player in support of the energy sector in Europe. Just in 2024, we deployed more than 31 billion in financing of renewable energy, battery storage, transmission networks and infrastructure, which mobilized more than 100 billion. Traditionally, we have relied on funded solution, either directly financing large projects or indirectly via banks, via partner banks in Europe. But in the last few years, we also see the need and the demand to expand our support beyond the direct financing, or beyond the financing of project to also to the value chain, such as I think already very successful implementation of the wind package, which is counter guarantees for performance and advanced payment bonds for producers of wind turbines in Europe. There we have already made available 3.5 billion to European banks to issue such guarantees, and this allow us to support also the generation and the implementation of new renewable energy projects. Similarly, when it comes, and we heard today, the importance to further develop and strengthen the transition networks. At the beginning of this year, and as part of the Clean Industrial Deal, we announced the GRID program, which is again performance bonds and advanced payment bonds for producers of grid components, such as cable producers and so on. The amount there is 1.2 billion euros as a starting point, and we hope to scale it up. I'm sorry for the long introduction and coming there. When it comes to the PPA, of course, we see it from two sides. Basically, in the direct financing, we observe and value the removal of the merchant risk for the financing of renewable energy projects. But also from my personal perspective, representing the financial institutions department, we want to support the implementation of and widening the scope of PPAs in Europe and in Central Southeast Europe by removing the credit risk from smaller companies, weaker credit profile buyers.
Very interesting. Thank you very much. And at this point, I would like to switch the lens from financiers to the development side. So, Alexander, I would like to ask your point of view of how batteries are performing and comparing standalone with co-located cases of batteries, and which one you see performing best and why?
Well, because we're in a panel for financing and lots of bankers here, it's quite funny because we spent a lot of time working with them to understand how solar works. Then we started working how battery works co-located with the solar, and then suddenly a standalone battery jumped in. So it's a quite volatile talk and quite volatile journey here. But yeah, battery is critical not only for developer investors, but for everyone in the mix. So that is providing flexibility, that is providing not only to investors but also to consumers and to the grid. We see now in Bulgaria that ancillary services have started working, and they provide to the TSO much needed instrument to balance this. Just to add on the topic that Nikola just said, that in a well-efficient market, virtual versus co-located would come to roughly the same output. Economically, yes, but in terms of balancing, evidently the battery would help provide that flexibility on the project and help the solar balance its schedules and be much more cost efficient from that point of view. So probably solar is important. That's generating wind as well, but the battery is the link between all this. So this hybridization is critical for the grid and for Europe if we want to rely more and more on renewables. And this is also very important now already with bankers and with lending institutions, because they see now and they understand much better than 1 year ago when that was a quite new topic and nobody knew the details. Now 12 months ago, after that, we see that most of the banks, we were speaking as a developer investors with most of the people here on that panel, that they now much better understand the economics of that project, how that works together, what's the difference between standalone battery and co-located, because they are very different to a certain extent, and both has its role in this market.
Okay, so the answer is simply both. We need both. And moving to UniCredit from a more commercial financing point of view, and leveraging from your experience for more mature markets like Poland or Spain, how do you assess that flexible revenue stream of storage in Southeastern Europe when we are lacking capacity generation mechanism, and how does this boost investments?
Sure, thank you for the question. Alex mentioned that actually auxiliary services and capacity markets are already advancing in Bulgaria, but from lender perspective, actually those markets are not that recognized. Although in external forecasts and reports, we do see forecasted revenues for such additional services. Often during certain discussions or during approval process, those segments and their revenues are actually not considered fully. They are often discounted, and from that perspective, forecasts and modeling is mostly relying on the usual core arbitrage services as well as self-consumption optimization, but not having advanced segments like capacity markets or auxiliary services doesn't mean that they have not to be considered at all. We usually, as a group, take a more holistic approach, and we try to actually benchmark how other more advanced and mature markets are developing, and from that perspective also consider this in our modeling exercise for the auxiliary services and capacity markets. Apart from the UK, which is maybe the most advanced market in Europe, we also consider a couple of other examples that are quite prominent and are closer to us. For example, one is Poland, where we already see that there is a supply of long-term capacity contracts where assets could actually enter into up to 20 years capacity contract, which certainly provides additional comfort for a lending institution. In addition, Germany is another prominent example where first the really good interconnection with Austria provides a common ground to actually tackle the capacity demand of around 2 gigawatts, meaning that there are different players from different countries that can participate in those capacity markets. And then in Germany, there is also another really good example that is being supported from the Renewable Energy Act, where there is a clear incentive for specific auctions that are geared towards renewable energy assets, meaning that even hybrid assets where there is a renewable energy production component, but also a storage asset, have clear opportunity to win such auctions because they have the renewable angle in them. And maybe finally, Spain is another really good example where stepping away from the batteries, actually even the solar PV assets can participate in the reserve segments, both for downward regulation, so meaning to reduce their production compared to schedules, as well as in certain cases also to work in the upward regulation. So in general, we can conclude that actually we should look into those assets from a broader perspective, not only to maximize the production capacity for a generation asset or to seek the maximum from an arbitrage type of revenue service, but a revenue stacking strategy that includes and incorporates a lot of other different services is the way forward to assess those bankabilities of such projects.
Thanks a lot for the input and the insights from other more mature markets. So we could simply divide the capacity mechanism in a long-term basis, capacity remuneration mechanism, and more a different capacity. We usually also call it ancillary services, which adds on the revenue stacking of those flexible assets as well. So finally, moving to Dimitar from CMS, and from a legal due diligence standpoint, what are the key red flags or gaps that most often hold back contracts in the region?
You mean during
PPAs or tolling agreements, if you have a chance to put your hands on any.
Let's talk about tolling agreements. Tolling agreements 2 years ago, nobody understands this instrument because simply there was no best projects in the region. Now everybody's talking about tolling agreements, but again, it's like a shady instrument. Nobody knows what exactly it's, how it works. But there are already projects which with signed tolling agreements, and we see that with the time people are relying on this instrument for both co-location and standalone projects. Actually, they have similar characteristics like a normal PPA, having for the bankability, having the criteria like credibility of the off-taker, which of course is in the first place for the banks, having off-taker with a strong balance sheet or good ranking, or with bank guarantees. The tenor of the tolling agreement should be the same or similar, at least similar to the term of the loan. Also step-in rights of the banks, direct agreements, this is always in these agreements. But there are also some important differences and challenges when structuring this instrument, and I will mention 2 of them. One is the technology. because it's a new technology and nobody knows how it will work in future for long term, how it will be managed, what are the challenges for the warranties, and the second thing is the allocation of the responsibility. Who is responsible for the proper management of the battery? Because usually we have the battery producer, we have the EPC contractor who is supplying the battery, then you have the owner, you have the O&M contractor, you have the off-taker, you have the software provider. Who is responsible for the proper management of the battery? You have the insurer also. And then the allocation of the risk between all these players is very important to be settled properly in the documentation. And it's a challenge because nobody wants to take the responsibility. And here, of course, I can say my preference, who shall at the end take the responsibility for the management of the battery, but it's an open question. It should not be the SPV. And not the banks, of course.
And the limited number of off-takers makes this exercise even more difficult. And with that point, we close our first round of questions. And moving to the second one, and Manuela, I would like to ask you to begin again, and asking you if you can share examples of EU-backed guarantees. We already discussed about tolling agreements, capacity mechanism, industrial PPAs, but those guarantees also help unlock finance. So maybe from your experience, could you share some insights?
Yes, I will. I think we need to be clear that these guarantees normally have a wide umbrella. So, for example, I mean, before we heard a bit about particular guarantees for PPAs. I think what we are doing is we are one of the institutions that works with InvestEU guarantees, and of course this is a product that the European Union put in place in order to help accelerate the green transition. So it is probably at the moment quite widely used for a number of projects and financings across a variety of institutions. I've actually checked yesterday the figures, and to date, 22.5 billion of these EU guarantees have actually already been approved. That's the data from March 25. That means not only for green projects and not only for renewables, but across sort of the European Union for a variety of projects. And if I may just say what we have used them for, we have used them for the fully merchant PV plant in Bulgaria, for example, and here we have used them in order to reduce risk on the project because it was a fully merchant project and because, of course, there is a volatile market and very little visibility long term. And so here the guarantee was very important to unlock the financing in the first place and make sure that the risk that the banks are taking can be covered. I know that wind farms in Croatia have been also financed by guarantees in the same way as, for example, also energy efficiency in Romania. Where we are now looking to use the guarantees is in what I talked about before, is in these portfolio projects that we are financing because there is a certain risk because these are large transactions. And what we can do is to use guarantees in order to pass them through to the developers. That would then be passed through in the form of, reduced pricing. But it can also be used for the banks as such, and also the partner banks or our partner financial institutions, in order to actually unlock projects to be done. And I think in the case of batteries, where we heard exactly where there is still a lot of risk, a lot of lack of visibility, how they will be used, and how, in particular, long-term returns can be achieved. These guarantees will be very instrumental in unlocking financing. So I think that's what I have to say. It's very general, but as I say, we have these instruments are very versatile. These instruments are have a wide range of applications, and at the moment I think it's working with the developers, working with the other partner banks to really see how these guarantees can be use to unlock actually financing for important projects.
Thank you for that. And you also mentioned, other than guarantees, the merchant exposure, and we all see that shift towards more merchant exposure on projects in the latest years. And either this is through PPAs, where the standard practice is with a combination of a guaranteed price and a merchant exposure, or tolling agreements with profit sharing schemes. So, Nikola, I would like to ask you what has changed, or how has the appetite from investment standpoint changed on taking over merchant risk?
Thanks. I'll try not to repeat what was said and just build a little bit on it. I think, as Manuela also said, everybody sees that there is a movement, that there is more and more projects with merchant risk exposure happening in the market. I think it's amazing to just see that actually Bulgarian wholesale electricity market developed to a stage where we can have this kind of structure, and where investors and banks are willing to take the risk. I think just 5 years ago this was probably not imaginable, so it's a great achievement. I would like maybe just to comment on one thing. We talk about PPAs and we talk about merchant risk, and I think in the view of IFC, this is not a choice between PPAs and merchant. We see PPAs as part of the merchant risk, if you wish, if you can say it that way, in the sense that terms of any PPA are actually going to be a function of the expectations of the market. If you think about a long-term PPA, it will never survive over a long period of time if the underlying price of that PPA diverges a lot from the spot prices on the market. So we think that even projects which are structured with PPAs actually do indirectly assume quite a bit of merchant risk. With that in mind, the approach of our institution is to try to support project owners with commercial strategies that they see best fitting their own needs and skills, be that fully merchant or commercial PPAs, or a combination of both. I think going forward, in terms of how this will evolve, I think one of the important topics will be how to have flexible financing terms which can support dynamic and evolving commercial strategies of the project owners. I think everybody in the industry knows that it's actually impossible to lock in and determine your commercial strategy at the time of when you're approaching banks to obtain financing. You can't sign PPAs when you still have not even started constructing the project, and these opportunities actually tend to come also during the operations phase at later stages. So it's important to have financing structures which actually can support the dynamic changes to the commercial strategy. And in that context also, it's very important for the project owners to develop that expertise. And I think those who invest in obtaining that expertise, in experimenting and doing different things, will be able to also obtain better financing terms from the banks in the future, because we will not be looking just at the commercial strategy per se, but also at the project operator, the owner, and their commercial skills, and how well are they able to respond to the changing dynamics of the markets. And that will be an important part of the risk assessment of any lending. Hope I answered your question, and a little bit more.
Yeah, and if something is missing, I would like to switch to Nikolay from European Investment Bank and share your thoughts on industrial PPAs, and maybe add how the Green Industrial Deal, as mentioned previously also on another panel, influencing this.
Yes, thank you very much. Yes, I mean, of course, the Clean Industrial Deal, I believe the Commission has outlined points with concrete timelines for how to improve the regulatory environment across the EU, which I believe would be also very supportive. On our side, of course, as a bank, we can only focus on a limited set of the challenges that are in front of the broad deployment of PPAs in Europe. So basically what we are currently working on, and hopefully we'll have the solution ready by the third quarter and available to banks by the end of the year. Is a counter guarantee for banks who then they can issue guarantees on behalf of buyers. Those are, in our view, should be smaller companies, maybe weaker profile, weaker credit profile. The idea behind is that such guarantee will make a PPA with a weaker buyer actually bankable. That means for the lenders of the project, it's something that can be recognized and taken into account. So this particular initiative, it's a pilot. It's the initial amount deployed will be 500 million. It's for all of the EU. It will be distributed based on the demand, depending on how advanced markets are, how widespread PPAs are on those markets, and of course on the readiness of some banks to participate. Just a final word. We believe we can nevertheless deploy it fairly quickly across the EU because we already cooperate with many banks via corporate guarantees, via guarantees for corporate risk for mid-caps, large SMEs, and small corporates. So it's very easy for us to replicate or to extend our cooperation with such banks to also include guarantees for PPA.
Thank you very much. And shifting again the discussion back to storage, we discussed about predicting merchant revenues, and due to the fact that there is limited offtake appetite on tolling agreements, it's a question again back to you, Alexander. How, from a developer side, you see negotiations for tolling agreements, or maybe the lack of appetite from off-takers, and might this be a limiting factor of having more capacity of storage in the mix?
Definitely. In terms of predictions, we evidently, I mean, every one of us depends on you, on Aurora and others. But yeah, just to give you an example, so 1 year ago when we started financing our first batteries, so we commissioned 140 megawatt hours last year in Bulgaria. So the first talks with banks were what can be the leverage percentage. So banks were not aware how that technology works. So they were trying to manage it between the risk and say, well, we understand that you look for 70% leverage, which is standard, but then we can provide like something like 50. So it was like a mixed deal. So let's start with something lower, and then when it starts working, we can increase, which is understandable because of the unknown here. Definitely for me, leverage is crucial. Deployment of battery, and that's installation perspective, deployment of batteries is much more easier and quicker than solar or wind, much more. Meaning, we've seen a couple of months ago how Restore grant financing scheme in Bulgaria collected around 10 gigawatt of submitted projects, and I can tell you that at least 2/3 of these would happen one or the other way over the next 12 months, which is spectacular, given that last year utility scale in Europe there were less than 10 gigawatts installed. So Bulgaria would deliver, one of the smallest countries in Europe would deliver roughly same volume for 1 year. So that's unheard of. But again, in order to do this, and we see that also China is stepping up to the challenge, so they increasing capacity of production more and more, and making the cost of the battery even less, so much more attractive to invest. So in order to do that, in order to facilitate that deployment, we need not only banks willing to take part of this, but banks willing to take a bit more risk, because actually battery, especially standalone battery, is quite a risk-averse product, because I mean practically it works. It does not depend on generation. Project development and commissioning is quite easy, so less risk there. Supply is also limited because it's a usually plug and play solution. And the battery is the standalone battery is the most flexible of all the renewable technologies available, meaning that that it can work on a capacity market or ancillary services, or just do arbitrage when that is needed. And if we look forward how that market will develop, we can see that renewable energy is replacing baseload energy. I mean, there is a lot of evolution to be seen going forward. Wind has especially crucial part in this in order to balance solar. But again, battery can play all that place. And because it's so much flexible, it actually is the perfect solution to finance, because it can work in any market. So from that perspective, given that now banks both in Bulgaria and Europe has more than 12 months of experience with batteries and with structuring such financing, I believe that they would become a bit more risk-taking and provide a bit more leverage. Definitely DFIs like IFC and EBRD and EIB has that role, because they have that risk inherent in them, so they can provide that a bit upside to investors, to give them a bit more trust in what they do and provide a bit more leverage. For me, definitely we see that in Germany, for example, how leverage can get up to 85% for batteries. So I expect that over the next 12 months, that is the target for everyone.
Really enjoyed that positive approach of batteries and storage, and yeah, the fact that they can benefit on different scenarios where we might have higher demand and the batteries can capture high peak prices, or either low demand and negative hours, and they can also charge there. So yeah, they allocate the risk on their own nature of flexibility during operation. And shifting the discussion back to more PPAs and tolling agreements, and when you're evaluating those projects, and you have weaker or less credit-worthy off-takers, are there any precautions or protections that you typically do to feel comfortable with supporting such cases?
Yeah, thank you for the question. I can only echo what has been said so far from the panelists and during the other sessions. Definitely guarantees and support schemes do help commercial banks to mitigate to a certain extent the lack of off-take agreements or the merchant component, or if there is an off-take agreement but the creditworthiness of the off-taker is more, not say questionable, but needing to further analyze this. So from our perspective, we also look at things from another direction. Historically, we have supported more than 1/3 of the installed capacity of renewables in Bulgaria, and solely during last year, we financed more than 550 megawatts of installed capacity. So we have a way to assess this and address this. One of the easiest things, but hard to negotiate actually, is to seek an additional cash flow to support the credit standing of the project. Of course, it's easy to ask the sponsor for additional recourse. It's hard to get. Having an operational asset in a mix with the greenfield financing that we are providing usually also helps, because in case of any shortfalls, the additional residual cash flow from the side project or the sponsor will mitigate any incompliances. Another way to enhance the bankability of the project is to, from the very beginning, start debt sizing exercise more conservative, meaning to have higher DSCR during the sizing of the debt, and also tighter lockup ratios. Having that would usually end up in the project with more excess cash flow, which will play as a buffer in case of any market volatility. With respect to the merchant price, what we usually do in terms of forecasting is to take the lower curve, which in any case already accounts for the market cannibalization that is ongoing. And we do see that the solar capture price in recent months have been trading less than 70% out of the base load price. So having the low curve usually provides another layer of sensitivity. And finally, what was also mentioned during the other session was the fact that sometimes the available PPAs are with a shorter tenor compared to the usual project financing. And what we tend to do is to provide a bespoke structure which is built around this offtake agreement, meaning that we have some sort of a mini-perm structure where the tenor is aligned with, to a certain extent, with the offtake agreement. At the end, there is still midterm visibility based on this fixed offtake. There is, again, the merchant component, but there is also the clear incentive to conclude additional rolling PPAs. This will mean that any embedded cash sweeps will be reduced, and there will be more cash for distribution to the sponsors. But if there is limited liquidity for rolling PPAs, then the cash sweep mechanics usually kicks in, and then we see a situation where there are larger prepayments of the debt quantum, and there is a reduction of this merchant tail component at maturity. So the de-risking is obtained from that perspective. Usually, of course, combination of those three mechanics tend to lead to a bit lower leverage on the project. But from our experience, even in more volatile market environment, which we have observed already in the last couple of years, the embedded buffers from having those three pillars provide the comfort that the projects will remain afloat, and we haven't seen any major issues in our historical track record of building such cases.
Thank you very much, and also being cautious of the time, that leads us to the last question of the panel with a forward-looking view about the tolling agreement, and what would you suggest as a legal advisor on tolling agreement practices that would make it more robust?
First of all, I think we have a good start, Bulgaria, with this capacity. It will happen, have proper instruments for PPAs and tolling agreements developed this year, which will give comfort for the banks, I'm sure. But I think the biggest challenge I mentioned, to gather all these players, 6 or 7, on one table, and to agree who should bear the risk. Because it shouldn't be the bank or the SPV. And sharing, knowledge sharing, technology experience, as Alexander said, it's important for all people on the market, because this will give trust and sharing. This is also very important, because I see only few developers or players are getting experience now on the market, and it should be shared with the others.
Okay, that gives us a few minutes maybe to take some questions from the audience. Would someone have a question? Please raise your hand. Looks like we covered almost everything then. I don't know if you have any closing remarks, something to add, since we have a couple of more minutes. Nikola?
Because you said I didn't answer your earlier question in full, so just to come back to it really quickly, I think the question was also what has changed and what made banks and investors be more acceptable of merchant risk. And to connect it with what Alex was saying, I think it's learning. I mean, banks are very conservative institutions by their nature, but slowly I think we've been learning about this merchant risk and how we can find structural solutions to accept it, and how we can actually understand it better. I think that helped. I think also learning on the side of the investors. And I'm going to say now something that slightly differs from what Alex is saying, in the sense that I think also investors learned that you cannot have a fully merchant project with 20 years loan and 86% leverage, and that a somewhat more conservative financing structure is required for financing merchant risk. Batteries are definitely a game changer in the way, and I think now we learn how to do merchant risk for generation, and now we are learning how to do it with the batteries. I think market is running a little bit ahead of us in terms of all these projects being implemented, and we are playing a bit of a catch-up, but hopefully we can be fast and be there to support investors like Alex and others in the room to implement these projects.
Yeah, I was trying to provoke the bankers here with 85% leverage, but actually it's not a joke. In Germany, you can get a 10-year PPA or 10-year tolling agreement with fixed prices, so then risk is limited, and it's all guaranteed, so why not 85%? But again, same in Germany, we see now 7 to 10 year PPAs, 5 to 7 year PPAs, which are open to merchant, fully merchant, meaning that banks are coming to the table of investors, saying, because it's also always a trade-off. So if you want longer PPA and better pricing from the bank, you need to provide that. If you want to get, but you lose the upside of the battery, so all that upside that you can get from the market. If you go merchant, you get less leverage, but again you can earn much more in the future. So it's a trade-off. I mean, as Nikola said, banks are willing to provide everything. Depends what you want.
That's totally true. I can say that, and we take very much. I think that being a bit challenged on the 85. I had actually a question to you, Alex, because you said that you were really confident that 2/3 of the batteries that bid now under the recent auction would be constructed either now or in the next 12 months. So I'd love to hear a little bit more, because probably I had a bit of a more conservative view on this. That's probably not 2/3, and I would just love to hear what makes you that confident that all the projects, which were extremely, large, but also, very positive, of course, for the tenders, but that really 2/3 would be constructed.
Yeah, first, some of these projects would happen with or without restore. So I said with or without. Probably the biggest hurdle for that delivery is the timeline. I mean, to reach to 10 gigawatt, the bulk of that would come through big standalone batteries. And big standalone batteries mean substation, mean very, very heavy grid connecting, and that first is a heavy exercise that takes roughly 12 months. And before that, you need 12 months to order the power transformer. So you have to order that 12 months before the program, and not a lot of players did it. And second, there are very few companies that build substations, that build that mid or high voltage grid connection, meaning that there will be a bottleneck there as well. What gives me comfort to say that is that's our perspective. So SUNOTEC is the largest PV installer in Europe, and we are also very, very quickly getting a lot of work in battery storage, not only in Bulgaria, again in multiple markets in Europe. And that's why we have that perspective. I said again, deployment is quite quick in batteries, apart from the grid connection, and from what we see in hand, what we have in hand, we believe that somewhere between 50 and 60% of that can be delivered. Again, there is a lot of work from institutions like the TSO, the local TSO, all the DSOs. A lot of work from the bankers to structure that, because that's not easy as well, and it takes time. And financing also sets the timeline when you procure and when you can deliver the batteries or the other equipment. So again, a lot of parties has to coordinate. I believe from what we see here in that panel, that everyone is aligned to the topic and is working what they have. Earlier today, the CEO of the TSO also confirmed that institutions are also aware, because let's be fair, standalone batteries are getting that financing because this is the most useful tool for the TSO. So they're a direct benefit, directly benefiting from that. So I believe everyone is aligned for this. Again, the major challenge is the timeline.
And this applies not only for Bulgaria. The timeline that you mentioned is also for Romania and Greece. But we see markets are being quite creative on how to support batteries. And maybe a last question after this discussion would be, if anyone is willing to take it, which structure works best, CapEx support or CFD operating aid support from either an investor's perspective or financial institution perspective?
I'm looking at the colleagues here. I'm now thinking about my risk officers who would look at that, and I think in that way a CFD is always a contract with the government. Governments are volatile. We have seen in the past that things can change retroactively, so I would go for the CapEx because it's upfront, but that's kind of the immediate reaction.
I think it really depends for whom. Yeah, I think, yeah, indeed, for banks, from credit perspective, yes, CFD is the easiest solution and probably can bring you to the highest leverage. But is it the best solution for the country? I think it's to be thought about and implemented where needed and for what it is needed.
Well, evidently that one is a CapEx one, but CFDs, all similar instruments are very important for the market because Bulgaria is very quickly developing both in solar and in batteries, but actually we lack a demand side. We lack that PPA and tolling market that can provide 10-year perspective, that can facilitate what banks, risk departments of bank want, and so on. So I believe that the state has an important role in that. We see that instruments that has been or caps that has been created in 2022 still work here and practically kill the incentive of corporate off-takers to get seriously into the market. So I believe that it might not be a CFD, but there should be an incentive for the corporate market to jump into that game, and that would open a lot of doors and make everything much more easier. So previous panel they've said, Nick Bitzio said, demand side is very important. So we need all of the participants in that market should work toward that.
Thank you very much. You have something to add?
Yep. Maybe just a final statement from my side. Also, as mentioned in the previous panel, there should be a balance, and given that capex prices are decreasing in recent months, I would assume that the state support and any government support should be actually geared towards the other issue, which is the fixed offtake. So any liquidity there in terms of higher demand and optionality to contract even short or mid-term CFDs or fixed prices will definitely help open the market and also unlock further financing opportunities.
At this point, I would like to thank the panelists for the insightful discussion and the inputs given, and the audience for attending. Thank you very much.